Hi, this is Shweb. In today's session, we are going to revise cost of capital and business valuation for financial management, which is previously known as F9 in ACCA. So let's have a quick revision of cost of capital. In cost of capital, there can be different areas. For example, we are going to study first of all cost of equity, then cost of debt, then cost of preference share. In cost of equity, there are two methods to calculate cost of equity. First one is dividend valuation model. In dividend valuation model, there are two assumptions to calculate present value of future cash flows. So there will be two assumptions. First is constant dividend. If dividends are constant, present value of future cash flow is dividend divided by required return, and present value of all future cash flow is equal to market value. So if market value is given, so dividend divided by market value is equal to required return, and another name of required return is cost of equity. There is another formula in which there is an assumption that dividend will grow with a constant growth. In that case, market value is equal to D naught into 1 plus G divided by cost of equity minus G. D naught is current dividend, but if we add 1 year growth into it, it will become next year dividend. This is next year dividend. And there are two methods to calculate growth. G means growth. First method is historical method. In historical method, formula to calculate growth is latest dividend divided by the earliest dividend raised to power 1 over n minus 1 is equal to growth. Remember, this n should be the number of jumps. Do not include base year whenever you want to calculate the growth. Ignore the base year because growth is something like incremental. Second formula is Gordon growth model. In Gordon growth model, formula is G is equal to B into R. And remember, B is 1 minus payout ratio. Dividend per share divided by earning per share. It is dividend payout ratio. And R is return on equity. ROE, return on equity. If ROE is given, if B is given, you will multiply both of these to calculate growth. This is payout ratio, and 1 minus payout ratio is equal to the retention ratio. So if you have the growth, if you have the D naught into 1 plus G, market value plus G, you can calculate the cost of equity using this method. But remember, always calculate the X market value. What is X market value? If dividends are announced, that means market value is cumulative. Deduct the dividend from the market value. And if it is written in the exam that dividends are paid, that means market value is already X. That means market value is excluded dividend. Second formula to calculate cost of equity is CAPM, and that is cost of equity is equal to risk-free rate plus beta into RM minus RF. Remember, whenever beta is given, it will always be given the beta equity. And this term is called the equity risk premium. So another formula is risk-free rate plus beta into equity risk premium. You can also name it market risk premium. So if you multiply these and plus the risk-free rate, you can calculate the cost of equity. Remember, stocks are equity are extremely risky, and there are two risks are involved: unsystematic risk and the systematic risk. This is market risk and this is individual risk. So this risk can be diversified away, but systematic risk will always be there. So there are two types of systematic risk. First one is business risk and second one is financial risk. Business risk is all about the nature of business, and it's all about the fixed cost, the operational gearing. Higher the fixed cost in your business, higher will be your business risk, and more risky your business is, more the more your business is linked to the economy, the more risky your business will be. Financial risk will be the risk of capital structure. Risk of capital structure. It's actually the level of debt. If you have taken the loan, that means you will face financial risk. Otherwise, there will be no financial risk if you haven't taken the loan. So if there are two types of systematic risk, beta has also two types. Beta is a relative systematic risk. It's a relative systematic risk. A company which has only has business risk, that company beta is beta asset. A company which has both risk, both business risk plus the financial risk, that company beta is beta equity. So beta equity has two risks, but beta asset has only business risk. So that means beta equity is greater. So if we remove the financial risk from the beta equity, remaining will be the beta asset. So E stand here for market value of equity, D stand here for market value of debt. So you can calculate beta asset or beta equity using this equation. But remember one thing, beta equity will always be used in CAPM. In CAPM, you will always use the beta equity. In KD, there are different types to calculate KD. First one is irredeemable debt. Irredeemable debt, KD is equal to interest into 1 minus T divided by market value is equal to KD. Remember, this market value will be X. Interest into 1 minus T divided by X market value is equal to KD is irredeemable debt KD. How to calculate redeemable debt? For redeemable debt, you have to make a table, for example, of 5 years. Put the market value in negative number, write the interest every year, take its after tax value, and last year it will be the redemption value. Discount these cash flow with two random numbers like 5%, like for 10%. Now you have two rates, two NPV. Calculate the IRR. That IRR will be equal to KD. That IRR will be equal to the KD. Okay, what about the variable rate loan? Variable rate loan, KD is equal to interest rate into 1 minus T. Bank loan, formula is same, interest rate into 1 minus T. For convertible debt, procedure is same. Year, let's say it's 5 years, put the market value negative number, interest into 1 minus T. In last year, it will be the redemption value. or the conversion value. The high, you will take the higher of value here. Discounted with two random number, for example 5% and 10%. You have to calculate the IRR. That IRR is equal to the KD. And remember, redemption value will be given. It can be equal to par or at premium or discount. Conversion value is equal to shares, number of shares, into current market value into 1 plus g raised to power n. That's how you will calculate the convertible debt KD. Okay, what about the cost of preference share? Only one cost of preference share will be tested in exam, that is irredeemable, and its formula will be preference dividend divided by x market value is equal to cost of preference share. Once you have calculated all these data, then you will calculate WACC, and WACC you will write all the data of, like, you will write cost of equity, cost of debt, cost of preference share. Then you will write the market values. Let's suppose market value is 1000 of equity for 700, and for example it's 300. Total is 2000. Now calculate the weightages. What you will do, multiply these all with the cost and then divide this value with this total to calculate WACC. So WACC will be, this will become numerator and this will become denominator to calculate WACC. It's very simple. First step is to calculate cost of equity, cost of debt, and cost of preference share. Second step to calculate market value of equity, market value of debt, and market value of preference share. Then multiply each market value with its cost in this column, and the sum of this column will be divided by the sum of this column to calculate WACC. That's how you will calculate WACC. Okay. Certain few things are also important. Assumptions of WACC. To appraise new project, existing WACC can be used if following conditions are fulfilled, like base risk of new project should remain same. That means the nature of the new business should be the same. Next is financial risk of new project should remain same. That means the gearing of the new project should be similar, should be exactly the same gearing of the business. If that is the case, you can use the existing WACC to appraise a new project. If that's not the case, then what you will do the other calculation, and that is, if business changes but financial risk remains same for new, obviously it is for new project. If for new project business changes but financial risk remains same, then you will use the project specific discount rate. Project specific discount rate. And what is that? First step, calculate beta asset of proxy company. You will search the beta of proxy. Obviously that beta will be given the beta equity. Use the equity and debt of proxy to calculate beta asset. This will be of the proxy. This will also be of the proxy, and to calculate beta asset using this formula. Then re-gear it with your on gearing. Use the same formula. Now, this equity and debt should be your own company. Calculate this. Next, put this into CAPM to calculate cost of equity. Then put this into WACC formula to calculate WACC. That's how you will solve project specific discount rate. Other than this, in this chapter, few things are very important, like capital structure theories. These are very important. Traditional theory, theory without tax, theory with tax, and plus there is another one theory, pecking order theory. I have made some videos on this, and that is also available on the YouTube channel. Plus, beside this, assumptions of CAPM, advantage and disadvantage of CAPM, why CAPM is superior model than dividend valuation model. This theory can also be tested in exam. Next is business valuation. In business valuation, how to value equity? To equity value, few methods are very important. For example, net asset. Obviously, the formula is very simple. Total asset minus total liability minus preference share value. Idea is very simple. But you have to do certain adjustment if there are any. For example, the monetary assets. Monetary, you should not do anything about the monetary assets. These are okay. But about the non-monetary assets, tangible assets. If purpose is going concern, place all the tangible assets at replacement value. If purpose is the disposal, place all assets at realizable value. If both are not available, then use the book value. Otherwise not. What about the intangible asset? Consider all intangible assets if market value is available. Inventory will always be at NRV whether it is higher or lower. Do not follow IS2 here. Receivables, less any allowance for doubtful debt. Liabilities will always be at redemption value. Second method is DVM. It can be tested in exam. It can be tested in exam in a two ways. Single growth model, that is market value is equal to D naught into 1 plus G divided by cost equity minus G. And second is multi-growth model. And that is, you have to do calculation for few years. Like for first few years, dividend will be given D1, D2, D3, D4. And after 4 years, cash flow will achieve a constant growth. So you will take this last cash flow and apply the formula of dividend growth model. This is the formula of perpetuity. Whenever you apply this formula, your answer will be at the end of last year. So for example, discount rate is 10%. Discount rate will be 0.909, 0.826, 0.751, 0.683. Whenever you apply this formula, its answer will be at the end of last year, so its discount rate will be the same, because this is the formula of perpetuity. Remember, whenever we apply perpetuity or annuity, its answer will always be at the end of the previous year, and sum of all these cash flows will be equal to market value. That's how you will calculate the market value. Next is P/E ratio method. Formula is EPS of target company into PE ratio of into PE ratio of proxy or industry average. There is another formula, so market value per share. Take the total earnings of target company into PE ratio of proxy is equal to total market value. Another name of total market value is market capitalization. There is another formula, earning yield, and that is EPS of target company. Target company means the company for which you are calculating the value, into 1 over earning yield of proxy is equal to market value. So that's how you will calculate the market values. Now, the market value of debt. First one, irredeemable debt. In calculation of market value, never ever minus the tax. Interest divided by required return is equal to market value. And what about the redeemable debt? You will have to make a pro forma. For example, 5 years. You will write the cash flow, interest, do not minus tax, redemption value, and discount these cash flows at required return or yield till maturity or before tax KD. All are same name for different items. Different names for same item. So this will be the market value. You will discount these cash flow with the required return, with yield till maturity or before tax KD. So discounted will be given using one of these names. Okay, for variable rate debt or for bank loan, market value is equal to book value. For convertible loan, exactly we will use the same process, right? The interest, but in last year it can be the higher of redemption value or the conversion value. Conversion value has the same formula which we have used above. Discount with required return, and the present value will be called the market value of the bond. And market value of convertible bond minus current conversion value is equal to conversion premium. What about the floor value? We will use the same formula, but instead of conversion, now you will only do the redemption. Instead of conversion, if you only redeem the bond, the market value of that bond is called the floor value. Discount these cash flow at before tax KD, required return or yield. Okay, for the preference share, formula will be preference dividend divided by the cost of preference share is equal to the market value. That's how you will solve these two, the market value of the debt and equity. Now try to solve past paper question and plus the past paper MCQs.